Hello, hi everyone. Welcome to this traditional Natixis research mid-year outlook for 2024. Every 6 months, we convene you to this event, a digital event, to talk about the scenario, what's the update to our scenario. So many things are happening. One crisis is not after the other. It's one crisis on top of the others again. So we see lots of political development, lots of things happening already. And this is just the start of it. We know the US election are coming as well. So not only economics, but politics are probably the name of the game. So today, what we propose to you is to have a bit of a 10 questions that we want to ask ourselves and to try to answer it for the rest of 2024. I think it's mixing a bit of a political analysis. Obviously, we need to take that into account, but more importantly, what we are better at, which is economics and analysis of what could be the consequences of all this. So maybe to start with, let me give you a global picture of our scenario within the research of Natixis. What we have in mind is that this is still not a Goldilocks scenario, but still what we have seen so far this year is not so bad situation where you see that US, China, Japan, even now Europe, so far, Europe is probably, all these big economies are probably close to their new potential GDP growth. US is above 2%. Europe is going to do something close to 1%, but probably a bit less than that, but not far from this potential that should be around 1%. China, we have chances to see China a bit below 5%, but very close to the current potential of China. You know, we are very negative or very cautious on China in the next decade for many reasons, but for now, probably the potential GDP growth of China is close to 5%, and we are going to be very close to that. Japan, again, we see all these big new economies like India doing very well. We have seen the first quarter above 8%. So if you take that together, the world GDP, at the end of the day, is behaving quite nicely, much better than we were expecting. So we are very close to a nice scenario for GDP growth. And then inflation, which was the name of the game for the last 2 years, we see this disinflation quite impressive. This is now sticky, that's for sure. We see that the road is bumpy ahead of us, but clearly we see the inflation in Europe confirmed at 2.6%. We were at 10.6% in October 2022. So it's fair to say that this disinflation is quite impressive. So this is very good news because in the end, probably the consumer, which was clearly lagging behind in Europe compared to the US, might see a bit of, and we are going to discuss that obviously, the potential dynamics of consumption with more real disposable income. And with disinflation, we see that now we have more central banks than in 2024 cutting rates than hiking rates. So this is the start of this pivotal moment where the majority of the central banks, we are going to discuss the BOJ with our expert coming from Tokyo, but clearly the vast majority, with the exception of Japan, is probably going to cut rates. It was already started in Europe, and this is not over yet. This is just a start, and we are still convinced that the Fed is going to start its own cutting cycle. So this is a very new environment compared to what we have seen the last 2 years, and compared to our scenario we exposed to you on back in December. In fact, the GDP growth is still there. All this question around inflation, I think we are on the money. We are still on disinflation. Future is obviously something to be discussed, but clearly this is a good, not a Goldilocks, but not so bad scenario. Then a lot of things can happen. We have seen that with the French election. European election, we are quite reassuring, but French election are something to worry about probably. And when we have done this survey, and thanks to you, thanks to all respondents to this very interesting answers you gave us, well, I think the big risk which was a pinpoint was geopolitics again, and we have seen that with this French election. We might see some market turmoil or market moving as well after the US election in November. So geopolitics obviously is one big question. Indian election are behind us. We have seen lots of things already happening, but UK are coming as well, but I think the big election, obviously, is the US one. And then the second big story is sticky inflation. So yes, I think it's a story. If we are wrong in this call that disinflation is going to continue, central banks maybe will be less of another leg to the recovery with more accommodative monetary policy. But this is obviously a big risk. And the second risk you were putting forward was the fiscal policy and real estate potential crash. We are going to discuss that. We don't think this is too much of a risk now, that, or at least, let's put it that way, this is not maybe the biggest risk for Chinese economy, for instance. But we're going to discuss that with all these 10 questions we want to try to answer with you this morning. Welcome to this Mid-Year Outlook 2024. Well, first question we want to ask ourselves is regarding Europe. Europe is probably at the core of the scenario. Like I said, I think Europe in the first quarter was doing quite okay. We have seen some reassuring stories regarding the election of European Parliament. We might see more of the same by the new incoming European Commission, but lots of questions regarding Europe, I think. So I'm welcoming with me this morning Dirk Schumacher, our chief economist for Europe, and Benoît Gérard, our senior strategist, because lots of things are happening these days around the French debt, obviously, but not only. So I think we need to discuss that. This is a very important question regarding the Europe. So maybe to start with macro picture with Dirk. Dirk, well, we had seen this with this euro area continuing, but well, what do we make of these European elections?
Well, on the European level, things played out more or less as expected. We had a moderate shift to the right, again, as expected. It's interesting to note that the European People's Party is probably the winner, the relative winner, meaning there's no majority left of the EPP anymore, which makes them kind of the agenda setter or kingmaker. But again, on the European level, there were no big surprises. The big surprise obviously was on the French side, that Macron, after the results of the European election, announced early elections.
So what is the scenario for Europe to start with, or macro scenario for Europe?
Yeah, we think that we have embarked on a general recovery that will carry on, mostly driven by consumer spending as real income is rising. I think that's a pretty solid case to be made. There are risks, obviously, not least from the external side, tariffs and all that. But we have, after 5 quarters of stagnation, started to grow again, and we think that will take us very well into 2025.
Is there any question regarding the wage spiral? I'm thinking of Germany. We have seen IG Metall asking for 7% wage increase. We have seen this almost 11% from Germany. Is it something to worry about? I know the ECB is looking at it quite well, with some attention at least. Is it something to worry about?
Well, rightly so. This is still the final shoe to drop in order to get the disinflation to be lasting, i.e. wages need to moderate for our call to be correct, that we'll see inflation trending towards target of 2% by 2025. There's some evidence this is happening, but it's more forecast at this stage than a fact, so we still need to see that. I think the German number have to be discounted, as you said, lots of one-offs. But again, the data will tell us. Our base cases, we're going to see this. But if not, then as you also alluded to, the ECB obviously will take note.
Can you tell us a little bit more on this confidence in this scenario of disinflation going forward in Europe for 2024? Well, this is a mid-year outlook, but maybe 2024, 2025, what are our target for inflation?
Well, around 2% by the end of next year. That's what we have in our forecast. It's going to be bumpy up until then because of base effects. We see disinflation very strongly in the goods sector. We don't see it yet in the service sector, and that's mostly because of wages. So again, this is the crucial part we need to see. We're confident we'll see some of it. Whether it will be enough to see services inflation trending down towards target, we shall see. But if that happens, we're quite confident that we'll get inflation to target, not least because wages have been driven up by high inflation. High inflation is not the issue anymore, as you said, 10.6, now 2.6. That should translate into lower wages.
So we might expect a little bit saving and more consumption with inflation going down, a little bit more of consumption going forward?
Yeah, definitely. As real income rises, that means consumption will increase. Saving rates will stay high, and that's actually to some extent good. If saving rates were to normalize, i.e. decline, like they did in the US, we could get too much consumption and therefore, again, inflationary pressure. So that's not what our forecast.
German, yeah.
French saving rates are very high too.
Yeah, that's true. We are still in France more than 2 points above the previous pre-COVID level. So yes, there are some leeway in terms of saving rate. Talking about France, sorry, Dirk, what do you make of the situation in France in terms of macro and maybe in terms of political situation?
Yeah, to state the obvious, there's a lot of uncertainty. What will happen? We'll most likely get a new government or a new party running the government. Whether it's going to be on the left or the far right, we shall see. Important point to make is that judging by the latest polls, it's going to be a minority government, meaning their ability to push through extreme measures, if they wanted to, is rather limited in that kind of scenario. And for markets, the crucial point is fiscal policy. How much of a fiscal stimulus do we get? Because if it's too aggressive, it would obviously get them into conflict with the European Commission, and markets might be very nervous if that happens.
Talking of markets, Benoît, you are looking at like if the OAT bond was a new BTP bond a little bit. What are you making out of this situation for French debt and spread? Is it the new things to look at?
Well, no, France is not Italy, the new Italy. It's fair to say that the current levels probably embed most of the risk. And now markets don't like uncertainty. It's not so much about the color of the next government. It's more about fiscal discipline and when it comes to governing the country. And the thing is, we think the range, the fair value of the spread might be between 60 and 80 basis points. So of course you could see some bouts of volatility. So the spread going back to 100% on the slide of market. But so far our baseline scenario is current level probably captures most of the risk we see now on the OAT bond.
So far, yeah, we have seen the issuances have been no big trouble. What could trigger a risk? Is there anything we have to look at going to the election and maybe to the rest of the year, depending on the outcome of this election? But what is the thing that could be a trigger that we have to look at?
Well, probably the main tail risk would be a fragmentation risk, so the risk of Eurozone breaking again and being priced in the OAT bond. There's something we're starting to see slightly in the CS market, but for now this is a tail risk. I mean, even if an extreme party comes to the government, we'll still have Macron, which is a strong supporter of the European project. So it's very unlikely that we get to that situation again.
Yes, we might see the market. Can we see a bit of a distrust moment from the market if we have some extremist projects coming to the parliament? Maybe we see some kind of a distrust moment. Is it possible to see that?
Well, fiscal discipline is still strong, I would say.
Okay, so thank you all. Thank you both of you. So what we say regarding Europe, you can see that the macro picture once again is not that bad. Obviously, the big thing is clearly the French situation, the political developments. To see again what we have. The good news is that no party is calling for anything but to remain in Europe. Euro is still very much popular among French people. So this is something which is probably a bit of a red line, which is going to make things a little bit more manageable, let's say, but let's see what's happening here. Obviously, the macro picture not so bad. Disinflation, central banks, we are going to talk about that later, but clearly something to look at with France. Thank you, Dirk. Thank you, Benoît. And we move to the next question. So next question is regarding the US. Well, we said about Europe, macro-wise, it's okay, but we have some political risk coming from France. well, US, maybe in a way there is some convergences here. Well, the US economy is doing well, but obviously the big uncertainty comes from the US election. So we're going to start with the first question regarding the US, because what has been very impressive, remember everybody was thinking of a recession. We did not, and rightly so, last year. But this year, what we see is, again, a very strong resilience of the US economy. So we start with Christopher Hodge and Jonathan Pingle, our two US economists live from New York. Hello, guys. We are going to start maybe with you, Christopher, with this question. We've seen this super impressive resilience of US economy. Is there anything like a soft landing in the US, or is it a no landing Goldilocks scenario for US economy?
We do indeed think that it's possible for the U.S. to have a soft landing, and we think the U.S. is going to experience it. Though we do see a bit of a slowdown in growth for this year, we don't see a contraction, and we're also quite optimistic about the outlook for inflation as well. Of course, there are many parts of the economy that are somewhat insulated from the high current rates. 95% of mortgages have fixed rates, and they average about 3.5%. And many businesses have termed out debt at low levels. But there are segments that have started to feel the pinch of tight policy. In the lower end of the income segment, we've started to see delinquencies rise for both auto loans and for credit cards. Savings rates are still quite low, and consumption is increasingly being driven by borrowing instead of through higher compensation. And on the other end of the spectrum, we observe a tremendous amount of wealth being accumulated, particularly among older Americans. Baby boomers are the largest and wealthiest cohort of Americans, and they hold close to 50% of household net worth. They've continued to travel, to dine out, and to visit their healthcare providers, and as a result, employment in these sectors has risen to record highs. Overall, this puts a floor under U.S. growth that's going to prevent any sort of contraction, but the economy can't thrive as it did in 2023, with about 1/3 to 1/2 of the population slowing.
Very interesting. And if we want to put a little bit more colors on this kind of a two-speed economy, Jack, how much gas is left in the U.S. tank overall?
Yeah, so U.S. consumption growth through the end of this past year has been remarkably strong. And the buildup of personal savings during the pandemic surely had a lot to do with that. Households built up over an estimated $2.1 trillion in excess savings over the pandemic, and further real income gains have helped to propel that spending even further. However, as Chris mentioned, there's been an increasing divergence between the financial situations of high-income households and low to moderate-income households. This pressure on lower and middle-income Americans has become increasingly hard to bear. Over 1 in 3 Americans that uses a credit card has it maxed out, with that notably concentrated at the lower end of the income distribution. This will weigh on these income groups throughout the coming quarters. However, with financial conditions for upper-income households still strong, spending looks to remain supported. Personal consumption in this light looks to be getting slower compared to recent activity, but may not actually become all that slow. With the financial situation of higher income households remaining in good condition and low to moderate income households increasingly under strain, the outlook for U.S. consumption looks to be pulled further and further apart by income. This leaves the outlook for the U.S. economy increasingly hazy and future growth more reliant on household wealth effects.
Same as with the ECB, we have all this discussion regarding the wage dynamic and the potential price-wage spiral in the U.S. Where do we stand in the labor market? We see some kind of normalization of late, but is it something we are confident that this normalization is going to continue on the labor market in the US, Jonathan?
Yes, I mean, looking across a broad range of economic data, you do see a general path towards softening the labor market. But there are conflicting views from different metrics, and certain sectors like healthcare and lower-paying services jobs are doing better than others. The household survey shows job losses are increasing and that the unemployment rate rose to 4% last month. On the other hand, the establishment survey shows gains of over 1.2 million non-farm payroll jobs year to date. The reality is somewhere probably between the two, with non-farm payrolls overstating job growth and the household survey dramatically underestimating it. And we'll likely see some large revisions, which will be released in August. Across a number of other indicators, we see things coming back into better balance. I think the big picture we see is a gradually softening labor market where the quits rate has been falling, unemployment insurance claims are gradually rising, and where job openings are back to pre-pandemic levels.
Very interesting, Jonathan, and watch out because Jonathan was not that bad at all, and we had some congratulations by Bloomberg on that revisions. Is saying that might happen in August on NFP, so watch out. Something might be cooking, but overall picture, I understand what you're saying. It is a normalization of the labor market, so no wage spiral, and again another factor in our expectation of rate cuts coming. Still, maybe a switch to Christopher. Any risk in your view of sticky inflation with what we just said? Okay, maybe immigration, maybe I don't know, but we see some risk still on the labor market. Any risk of sticky inflation with wages, Christopher?
There's definitely a risk, but I think what we've seen for the last two inflation prints is that there's a general unwinding of price pressures, and we do expect that trend to continue. The increase in the labor force, both from migrants and American-born workers, have added additional slack to the labor market that's helping it to bring it into better balance. And we think that this general trend should continue, and the path for wages are going to moderate from their current levels and settle into the 3 to 3.5% range, which is more or less consistent with target inflation for the Fed. So we're pretty optimistic on that front.
So thank you, Christopher and Jonathan. If I just summarize a little bit what we say regarding the U.S. economy as it is now, and now after that we speak about the election. But if we look at things as they are in our view now, we still think of a bit of a normalization of the labor market, of inflation pressures to diminish a bit, and then again the Fed could be, like we said, could be cutting rates starting in September. Thank you. We move to the next question. Well, next question obviously is around U.S. election and France. Europe has French elections to look at, but I think the world is more interested in what's going to happen after November U.S. presidential election. So maybe I think it's worth looking at the programs and what could be the difference between the two candidates. Christopher, to start with you first. Can you describe a little bit more the policy priorities of both Trump and Biden?
Sure. We're in a rare historical instance in which we have a race between two candidates who've already been president and have a record to show the voters. President Biden has prioritized industrial policy and decarbonization in his first term. And his budget for 2025, which is more of a wish list than an actual spending plan, but it proposes spending on social programs, focusing primarily on expanding childcare, education, and healthcare. To offset these costs, Biden is proposing higher taxes on wealthier households as well as corporations. On the other hand, we have Trump. When initially running for office, Trump was an outsider, and part of his appeal was his ability to not be tied down on the specifics of many issues. And there were only a few things on which his feelings were crystal clear, primarily of which were immigration and trade policy. These two issues will still be the priorities if he wins another term. As for immigration, he's constantly criticized President Biden for his lack of enforcement on immigration flows on the border, and Trump has vowed to stop these flows, and he's also pledged to deport millions of illegal immigrants, using funds diverted from the military to fund the effort. On trade, Trump's policy in another term would probably pick up right where he left off in his first. In fact, he's more likely to double down on his tariff policies than to back away from them. He had said that he's considering a universal baseline tariff of 10% that would automatically apply to all imports, and a 60% tariff on Chinese goods. And even if these extreme policies are not actually implemented, the fact that they are being discussed and considered is an indication that the escalation of the trade wars that we saw under a first term will probably be in store if Trump wins again. But these are the overall priorities of both Biden and Trump, and whoever wins will have to deal with Congress that may try to constrain these particular ambitions.
Talking of which, maybe with you, Jonathan, well, we see that very big importance of Congress as again, like in France probably, but can you give us a preview what can be expected from this election regarding the Congress, Jonathan?
Yeah, so in the House of Representatives, the Republicans hold a very small majority currently, and control of the House has gone back and forth many times in recent years. Typically, sweeping changes of control of the House occur in midterm elections, while elections in presidential years have been much more competitive. Given the slim majority currently, we have to say that control of House in the 2025 is essentially a coin toss. The Democrats, on the other hand, control the Senate at the moment. Of the 34 seats in play this year, Democrats will be defending 23 to the GOP's 11. Of the ones being defended by Democrats, 4 are in states that merely lean Democrat, and 3 are in states that are considered a toss-up. Democrats will also likely lose the seat being vacated by Joe Manchin in the solidly red West Virginia. Republicans, meanwhile, are only defending seats that are held in likely or solidly Republican states. So we feel pretty comfortable predicting GOP control of the Senate in 2025.
Very interesting. So likelihood of a split Congress, which is usually something that the market is not too much opposed to, because usually it's correlated with nice equity performances, but let's see. Maybe just same question for you guys. If Biden wins, maybe for you, Jonathan, if Biden wins, how would you characterize the impact on growth, on inflation of Biden policies?
Yeah, so without Democratic control of Congress, it's going to be hard for Biden to implement much of his agenda, at least domestically. His ambitious plans to expand the social safety net will not find any favor in Congress. He would, however, likely find common ground with Republicans on extending much of the Tax Cuts and Jobs Act, including the middle-class tax cuts. As for his trade and industrial agenda, we think the preferred policies are largely in place and don't envision him escalating the trade war any further. In sum, a Biden presidency with a Republican Congress would likely yield modest fiscal tightening, which would dampen growth prospects and inflation, but produce a slightly better fiscal outlook. There's an outside chance that, given his position as an elder statesman and institutionalist, Biden could initiate some talks about common sense budget or entitlement reform. This scenario is not a base case by any means, but just one potential positive outcome.
Same question for you, Christopher, but if Trump wins?
Well, there's definitely a wide range of outcomes, but we should probably just analyze the policies that have been presented by Trump himself. Should he embark on his plan for mass deportation and shutting down the border, implementing sweeping tariffs, and fully extending the 2017 tax cuts, this, we think, would be highly inflationary. In the case of immigration, increased flows have been cited as a key reason for the cooling of wages and, as a result, inflation prices. Migrant workers, both legal and illegal, are critical to many industries, such as hospitality, elder care, and construction, and stopping these flows could contribute to shortages that we've seen towards the end of the pandemic. If Trump's proposed tariffs were to be enacted, their burden would disproportionately fall on lower-income homes. This is because of their higher propensity to consume and the broadening of these tariffs from being applied mostly to inputs and capital goods to consumer goods as well. And finally, if the 2017 tax cuts were fully extended, we estimate that budget deficits would be about 1 to 1.5% of GDP larger as compared to the baseline estimate right now. Now, these policies may be offset slightly by more energy production or a stronger dollar, but all else equal, these policies, we think, would yield somewhat faster economic growth, pressure on inflation, larger budget deficits, and higher treasury yields.
Thank you both. Obviously, a big game changer with election in the US. We see very, very big differences of program and probably differences of consequences to the world. On one side, you have Inflation Reduction Act, on the other, tariff policies and immigration. Well, if I have to say, probably it's a bit of a trade war still in the making, but well, let's see what happens in November, and we'll talk about that next December. Thank you both. We move to the next question. So after Europe, so again, 0.8% for Europe, 1.1 still for France in our scenario. So Europe, not that far from potential. The next big question we want to ask is regarding China. China obviously is a big engine of growth, more than 17% of world GDP. I have this pleasure again to welcome Alicia Garcia-Herro, our expert on China. Many things are happening there at the core of maybe the disinflation in the price of goods, but as well at the core of the trade war. So lots of things are happening in China with lots of challenges ahead. So welcome, Alicia. And first question, what are the engine of growth of China today?
So we just had May data, and we can see that consumption is still very weak. So retail sales grew barely 3%. And most importantly, fixed asset investment is weaker than ever, 4% growth. And mostly led by supply, meaning manufacturing, fixed asset investment. So what is left? If you want to grow 5%, you only have the rest of the world, which is exactly where we are, exports, and restraining imports as much as possible. So that's why China today has an enormous trade surplus. That's where growth is going to come from, if the rest of the world allows it.
Yeah, this is a big question, because what we have seen is that well, Biden is doing a little bit Trump policies these days, and Trump has said that he's going to do much bigger tariff than I'm a tariff man, keeps saying Donald Trump. So, and Trump is, we're going to talk about election again and again and again for the rest of the year, as we have seen. But clearly, the tariffs are coming from China and are multiplying. But as well, the new thing maybe is that the European Commission so far is, and we have seen with Dirk as well, that it might be more of the same if von der Leyen and the outgoing commission is again elected in such a way. We might see as well Europe joining the bandwagon, and the rest of the world is closing to China now these days.
Yeah. Well, some are. So we saw Turkey lifting tariffs, slashing tariffs at 40%, the tune of 40%. So our tariffs look actually quite moderate in Europe. By the way, they're not tariffs, they're just countervailing duties. So they're temporary. We don't know whether the European Council is going to actually support this measure by the Commission, whether the Commission is going to gain the case if China actually retaliates or basically goes to the WTO against our tariffs. So long story short, our tariffs are really a drop in the ocean compared to the US, let's face it, which means ultimately that we're not protected in terms of imports from China, whether it's EVs or others. And this also means to me that we will continue to have a big trade deficit with China, because China is still not importing from Europe. Actually, European exports into China are plummeting. So that's a reality we need to cope with.
Does it mean that the consumption on one side in China is very weak, because we see very, very low imports from China? So that's my first question. And second question, does it mean that China is again re-exporting its deflation to the rest of the world?
Well, on the import side, two things. China's consumption is low, but also China is substituting imports because it can. You know, it has moved up the ladder, so it has the ability to substitute imports of intermediate goods. That hits Germany at the core. But secondly, whether China can actually move away from this, it's a question of how much stimulus. We will have the third plenum. Jean-François, that's a big meeting. It's where China needs to say what reforms are coming. And if there aren't any, or at least a stimulus, I think the market will penalize China. But maybe we'll hear something positive on that front. Yeah.
Is the real estate story something which is something of the past, or is it less of a risk compared to the challenges ahead that you mentioned?
Well, the real estate sector in China is still in shambles. The latest data we got is only 3 out of 70 of the 70 largest cities are seeing a slight increase in prices. So you can see that it's still going down. But as everything on earth, when you are at very low level, it's hard to fall from the bottom. Yeah. I don't think the real estate sector will contribute negatively because it's already very weak. That doesn't mean it will massively help. We're still there kind of hanging.
Is it still 25% of GDP? Is it still grow?
GDP is about 21 now, but the point is the contribution used to be a third, and now it's negative. So falling from negative is hard. So I think we need to forget for a while about the real estate sector in China, talk about something else, because it's going to linger for a long time.
And what are the biggest risks then for China for the rest of 2024, maybe in the longer run, a bit longer run?
I would say immediately, and even medium run, is the local governments. Why? Because they've piled up huge amounts of debt. It's about 70%, including off-balance sheet debt, which we can't really measure well, but it is massive. And now there has to be, this is the third plenum, somebody has to say, what do we do with this debt? We're hearing rumors that they want to offload the local government debt, especially the off-balance sheet, the one we can't see, so that people stop worrying, like me, about that debt. But there's nothing really concrete. I think the central government needs to take this debt because it can finance it much more cheaply. But that's a big change for China. So we'll see if it happens. Yeah.
Second to last question. What is the risk with Taiwan? How do you characterize that?
It depends on who are we talking about. If we're talking about the Taiwanese, they're now undergoing huge risk, which is a political risk inside Taiwan, because there is an attempt by the opposition to reduce, actually so far quite successful attempt to reduce the power of the president, which is a DPP president, so incumbent, and that is a real thing. It could be a Hong Kong type evolution, and that means that for us investors, unfortunately, we focus on war versus non-war. That reduces the probability of a war because it might not be needed.
Thank you, Alicia. And just to end up, what is our forecast for China this year?
We keep 4.8%. It's very close to 5%. You could say more or less what the government is saying. That doesn't mean to me that the economy is really showing that growth, if you see what I mean. I mean, we know it's going to be about that, but we also know that the downward pressure on consumption investment is very obvious.
Thank you very much, Alicia. So we see China is doing okay so far this year, but lots of challenges ahead. Thank you very much, Alicia. Next question is around central banks. We were thinking that 2024 will be the year of the pivot, that all the central banks, the vast majority of central banks will be cutting rates. Well, this is more or less the case, but not that simple. We see a little bit of differences between central banks. We have the great pleasure to welcome again Dirk Schumacher for Europe and the ECB. As a former member of the ECB, we will know a little bit of what's going on. But I have the great pleasure as well to welcome a rare event of welcoming Koe Iwara. He's our specialist coming directly from Tokyo. He's following the BOJ, and he had some very, very good calls on the BOJ, a bit out of consensus, but I think he was quite right on that, to see that the BOJ will be struggling to get a lot of normalization of its monetary policy when the rest of the world is probably in a cutting rate path. And then we have Benito Berber online. Benito Berber is our chief economist for Americas to discuss the Fed as well. So maybe to start with, welcome Benito. To start with is with Dirk. Well, can the ECB decouple from the Fed and keep cutting rates, or is it possible to see the ECB cutting rates going forward, even if the Fed were not cutting rates?
Well, the ECB will decide based on European data. If the European data were to suggest that further rate cuts are needed, i.e. inflation moving towards target, then the ECB will cut. Now, of course, what the Fed does or not does have an implication on European data, in as much as the exchange rate obviously is also determined by Fed cuts or not cuts. In that sense, it will limit the ECB's ability at some point to cut if indeed the Fed remains rather hawkish. We don't see any Fed cuts. That's not our expectations, but if we were to see that, there are limits to what the ECB can do simply because the exchange rate might then change the inflation outlook.
That's a question we have a lot from clients. That is the euro something big on the ECB radar, or is this just a second round effect? And we see, surprisingly, in a way, that euro is behaving quite nicely these days, still at 107 as we speak.
Well, it matters for inflation to some extent. It's one of the many factors the ECB looks at. But of course, a huge depreciation of the euro against the dollar would have implication for inflation and would then change the ECB's mind. But the only channel through which it sees it, and it would need to imply big moves in order to be relevant.
What is very impressive is to see that the market has depriced almost 5 rate cuts from the Fed, and still the euro is holding up very well. So maybe turning to Benito Berber out of the US. Benito, well, a lot has been priced at the start of the year, 6, maybe 7 rate cuts by the Fed, which was supposed to lead the way on the downward path. And now we are very close to just 1 rate cut going forward. What is our view on the Fed? Are we still confident that this is a cutting rate cycle which is coming from the Fed?
Thank you, Jean-François. Well, what we see in the US is that the disinflationary process that was halted in Q1 continued in April and particularly in May. You might remember that at the end of 2023, there was a clear disinflationary process. That's when a lot of the cuts were priced in. That was halted in Q1. And then we see very optimistic view data, in April and May, particularly in the super core, and the implications of that, or what it means for the PCE inflation, which is the inflation measure that the Fed targets, are very important because we might be, in annualized terms, below the target. So we need to continue to see progress in June and July, and we think that's going to be the case in terms of inflation. In terms of the labor market, we see that the labor market continues to normalize. We see jobless claims increasing. We see labor churn, which is a measure of quits and hires as a percentage of labor force that is sort of moderating, and we don't see additional pressure in terms of wages. So if you put it all together, what we see is that the Fed will likely start a cutting cycle in September, and we see an additional cut in December. So to summarize, we see 2 cuts of 25 basis points this year, for the policy rate ending at 5% in December.
Thank you, Benito. So where does it leave the BOG? Because, well, we're talking about the Fed and the ECB, which are, in our views, on the cutting cycle continuation. 2 rate cuts from the Fed, as Benito said. What does it mean for the BOG going forward?
Sure. We expect the Bank of Japan to cautiously normalize to create room for a rate cut during rainy days when the good news are actually flowing in. For example, nominal real wages has been rising at the highest level in more than 30 years. And also corporate service inflation has been increasing with the inflation expectations elevated above 2%. These are good developments for the Bank of Japan to argue that the virtuous circle between inflation and wages is strengthening. So going forward, we expect the Bank of Japan to normalize further by reducing the amount of bond purchase and also rate hike.
Thank you, Koe. Thank you, Dirk, and thank you, Benito. So we see, you can see that our scenario remains quite the same as before, meaning that we are still expecting some rate cuts from the ECB. So again, September, October, December, and from the Fed in September and December. And as Koe is saying, BOJ, well, the whole world is becoming more Japanese, but the Japanese situation is becoming a little bit more normalized in a way regarding inflation. So BOJ might be able to normalize a little bit further its monetary policy, but not that much. Thank you, gentlemen. We move next to the next question. Thank you very much. Next question we want to discuss is the re-steepening of the curves. And that was a bit of a name of the game, an obvious trade, a crowded trade even, going into 2024 with all these central banks expecting to cut. And at the other end of the spectrum, probably a little bit more of term premium because we see the whole world doing the same thing, i.e. investing a lot in the green transition, investing a lot in military spending, investing a lot in digital, in coping with aging. So all these mega trends are probably pushing for more public spending, and we see that especially with the US. Think of that. Every 3 months you have $1 trillion more of debt out of the US. So obviously at some stage it has to put a little bit more term premium on the longer part of the curve. So given all this, is it still something to look at, the re-steepening, or, well, depending on what had just happened, it's already done?
Well, it's not done, but for sure we keep the faith. This trade has been struggling since the beginning of the year for obvious reasons. This massive repricing we had in central bank expectations, notably in the US, with 2-year yields increasing by about 75 basis points and reaching 5% a couple of weeks ago. The strong appetite by investors, notably on the long end of the dollar and European curve. So it makes things a bit the life, let's say, harder for people willing to play this re-steepening of the curve, even more when you are facing a negative carry. But we still believe that we'll have it. It's for us more a question of when than whether we will have it or not.
Yeah, and Cyril is our head of strategy, so I have to ask him that. What makes you so confident that it's coming?
Well, first of all, we know that the Fed will start cutting rates, and I think it's going to be the proper trigger everybody is waiting for in order to initiate this kind of re-steepening positions. Second, we are quite confident, in fact, inflation will be decreasing. And third point is that, you said it all, but term premiums are there to stay and might even get bigger ahead. We have interesting elections, very huge supply by notably states being in Europe or in the US, which fully justify, once again, steeper curves. The question of when is probably, in fact, September, when it's going to be a good time, in fact, to start initiating these re-steepening trades.
And if you had to play this strategy, where will you put this strategy in play? What are the segments you would favor?
In fact, very likely we'll start notably on the 2-year, 10-year segments, so quite a classical, let's say, way to play it. Not necessarily the very long end. As I said, we have very interesting rendezvous election-wise, notably in France, so maybe adding some flattening pressures on the very long end. So this is the reason why at this stage the 2-year, 10-year is probably, in fact, the segment we'll be looking at, both in euro and in dollar.
Thank you, Cyril. So as you can see, the re-steepening, this is still a strategy we believe in going into the rest of 2024. We now move to the next question. Thank you, Cyril. Next question is on FX market. We think it's important to ask ourselves a question regarding, well, obviously our forecast for, we're going to discuss that, but as well we were thinking that maybe a lot of questions are still around this situation of the dollar. And the question is king dollar a little bit king in a way? So to discuss this I have Alicia back with me from Asia. I have Ina Mufteva. Ina Mufteva is our expert on emerging economies, and Nordin Nam, our senior leader on FX market within the team. So maybe I'll start with you, Nordin. Is the dollar still, well, we know that dollar remains very, very dominant. What are the factors that we have to look at? Is it still going to be the case, in our view, that the dollar is going to be the dominant currency?
Yes, clearly, we expect in next year the dollar to decline, but it should be only a cyclical decline due to the interest rate cut from the Fed. But structurally, the dollar will remain dominant. We can see this through for central bank reserve at 59%. When we look also to FX transaction in dollar, it remains at high level of 88%. And when we look to payment also, 47%. So all of the statistics remain positive. And when we look globally, the dollar remains supported by the US economy, by political stability, a strong army, and a strong liquidity of US assets. So we don't expect any alternative for the dollar in medium term.
Just what is our forecast for euro dollar at the end of this year?
So we expect something around 109, 108. It will depend on now on the French election. It could have an impact on the euro.
Thank you, Nordin. So we see that, well, dollar, there is no question of that. It's still very much the dollar, the dominant currency of the world. But we see some countries pushing to finding alternatives and to put their own currency. And obviously, China is at the forefront of that.
China has indeed tried many times to internationalize the RMB since 2010, through Hong Kong, then through a digital currency that never actually was used cross-border for the time being. And this time around, I think it's a very smart strategy. It's basically trying to bank on our sanctions, indeed. So by trying to offer the RMB to countries that want to bypass G7 currencies. And it's working for those countries. Clearly for Russia, even for India to import oil. The last thing I want to say is that China is also offering, and rightly so, lending in RMB. So countries are kind of keen to borrow in a cheaper currency, in the sense that first we think it might be even cheaper in the future for that matter, plus very low interest rates compared to the dollar. So it has these two functions. Payments of trade for certain countries, but certainly borrowing for frontier markets.
So maybe a question for both of you, Ina and Alicia. We see this push of the global south, let's say, to find alternative to the dollar. Is there is it a myth so far, you think, Ina, that we are going to see some alternative to the dollar to avoid this weaponization of the dollar? Is it a myth or reality at the moment?
Well, the dollarization is definitely not a myth. It's not surely completely a reality yet, though. I would say it's a trend. Probably a bit of a bumpy and a bit of a longer-term nature, but it's a trend we've been seeing already for several years. And this is the trend which has been exacerbated by the Ukraine war, actually. So probably I will just give you two examples. So first example is the foreign trade. We've seen a myriad of the bilateral trade agreements between the global south countries, basically to denominate the trade between them in the regional currency instead of the dollar. And this is what Alicia just already mentioned. So the role of yuan, but not only India and Malaysia to denominate their trade in the Indian rupee, for example, or Indonesia and South Korea, but also China and Brazil, Argentina and China again. So many of them. So definitely it's something we've been looking at. Second example, probably just on the foreign trade as well, is that if you look at the part of the foreign trade of two countries and the currency in which they are denominated. So for Russia, if you look like around 10 years ago, 80% was dollar trade. Already in 2020, just before the war, it was already at 50%. And if we go back to China, so it doubled recently, so in the last 7 years to 20%. So 20% of global trade is already denominated in yuan, and we can't completely ignore this situation. And the second probably example is the payment system, proliferation of the regional payment system. So after the sanctions were imposed to Russia and the Russian banks were excluded from the SWIFT system, a lot of countries actually took kind of a skeptical view on their exposure to the US dollar into this weaponization of the financial system, of the SWIFT system notably, and so many of them developed their own, and even before that, beforehand, their own payment system for interbank systems, so India, Russia, China, and in India actually the payments through this system already like half of their GDP.
Thank you, Ina. So you see that the dollar domination is not over yet. It's maybe the start of a slow decline of the domination of the dollar. May I add one thing as well, is that we see the world getting more and more regionalized. The world trade is more and more in blocks in a way. So if you are producing more locally, maybe you are less used for the dollar in trading goods. And second thing maybe as well is that if you are accelerating your green transition, you are producing your energy more locally with your sun, with your wind, with your biogas, with your nuclear energy, which is probably, well, maybe less for some, but globally you are less using the dollar to buy some coal, gas, and oil as well in the future. So this is a global trend probably, but not there yet. So thank you very much, Alicia, Ina, and Nordine. The King Dollar is dying, but very, very slowly. Thank you very much. We move next to the next questions. The next question we have in mind is regarding the question of debt. We were mentioning that before. We see all these big mega trend, deglobalization, green transition, aging population, military spendings, digitalization. All these things, they take a lot of public money, and we see that with debt to GDP rising. And on top of that, we have all these crises, COVID, energy crisis, adding up some pressure on debt to GDP. So the big question we want to ask is around this debt sustainability with Dirk Schemauer back with us and Benoit as well. So maybe the first question for you, Dirk, with the current level and dynamics of rates and debt, where do we stand in terms of debt sustainability globally, but in particular in Europe, for instance?
Well, obviously, there's not the one answer. You have to very closely look at specific countries here. If you take the US, obviously, it's in a special position. The US debt sustainability is not put in doubt, that's for sure. In Europe, you have countries with very high debt levels, like Italy, and France somewhat behind that. You can then again look at how do these debt levels develop, assuming certain macro scenarios, which we have done. And the answer would be, well, in all cases, if we take those countries with high debt levels, it's not in an explosive path. So it's probably about stable or even declining in the case of France, all else equal. But fiscal policy, i.e. what's the deficit going to look like, is the crucial question here. So even if it doesn't look explosive, a government that would be reckless could obviously turn it into an explosive path.
Yeah, we have seen the bond vigilance with Liz Truss, but we might see something like that in France. Let's see. Question for you. We have published something under your direction on the neutral rate. This is a very complex question, but still, where do you think the equilibrium rate are going to be in this context of rebalancing between global saving and global investment? And we see less and less saving, more and more investment, or at least more investment compared to the saving. So probably it means higher equilibrium rate now.
Yeah, it must kind of almost per definition, in a sense that if the neutral rate reflects the equilibrium, as we said, between demand and supply of savings, if there's a lot of demand because fiscal policy is very aggressive, at the same time the supply savings cannot go further up, then yes, all else equal, that leads to higher interest rates. And this is indeed what our research shows. Already over the last couple of years, expansionary fiscal policy has pushed up the neutral rate maybe by 100 basis points. And it could go up by another 100 basis points depending on the fiscal outlook. So yes, this is very important for the medium-term outlook for interest rates.
If you have to put some numbers ahead, what is our forecast, or at least our model, what our model are saying regarding the new neutral rates in Europe, US?
Well, in the US, it's probably now in positive territory, something like plus 50 basis points or even a bit higher. In Europe, we're now around 0, a bit slightly negative. We were 100 basis points lower in both cases a couple of years ago. So we have seen this shift according to our modeling. And again, it may go further up similar amounts depending on the fiscal path.
So it means if we have a 2.5% inflation, the new inflation rates, it means probably nominal rates around 3 for the US, 2 for Europe, let's say. Roughly.
All else equal, there are of course cyclical factors, there are central banks, but if you look through that, yeah, this is what higher fiscal policy in the end would imply.
Benoit, why the markets are so relaxed regarding debt to GDP? Is it because everybody's doing the same thing at the same time, or what is it happening now?
Well, relaxed. It used to be relaxed before Macron called the snap elections. I mean, we're starting to see some stress again in the CS market, which is a particular market, not as liquid as the cash market, but still we're seeing some movements in the CS market. So the credit risk is being embedded again in European debt. And everything is going to be dependent, of course, on what happens in France after the elections, depending on what is the fiscal plan. Again, we have an institutional framework in France. Our baseline scenario is for 3 blocks with no majority. So again, limited fiscal slippage. So that's maybe one of the reasons why the spreads are remaining quiet, I would say. But Italy, there might be some spillovers over Italy, the Italian debt, because Italy used to trade as the higher end of the spectrum, the credit risk spectrum. It's been performing very well in the last 2 years, and now maybe it's time to reconsider Italian dynamics, at least from a market perspective.
Earlier on, you said the range for the OAT bond is 60-80, with maybe some overshooting sometime, but around these levels going into the election. What about the BTP bond?
BTP bond, I would say it should be a fixed spread to France, BTP to OAT, but maybe current level as repriced after the market turmoil we saw. Current level maybe embed again the most of the risk we can see coming from France, not coming from Italy. This is spillover from the OAT market to the BTP market.
Now, what are the impact on swap spread in this context of rising debt, public debt? What is the impact we might see on that matter?
All else equal, we should see some fiscally virtuous debt like German, for example, a widening of the spread, so cash overperforming the swap market. And on the contrary, you should see a compression of the spread for BTP, for example, so the cash underperforming the swap.
Maybe a question on that for you, Dirk. Is there any chance or risk, I don't know, if I'm a French, I will say chance, to see German moving on their debt, well, golden rule of Germany?
Despite being German, I would also call it a chance. I think there's a good likelihood, a high likelihood, that the next government will change the debt brake simply because it implies at this stage a quite contractionary fiscal policy, and I don't think that that's suitable in the current environment.
Thank you, Dirk. Thank you, Benoit. So you see, this is obviously something which is going to be at the core of the market attention going forward. So far, it's okay, but obviously the fiscal dynamics are a bit of a challenge in this environment. Thank you, gentlemen. We move to the next question. Thank you. Well, we talk about debt markets, and now we have to broaden a little bit, to zoom back a little bit and think about asset allocation with 3 experts on the plateau. I welcome Florent Pochon, our senior analyst on asset allocation problematics. We have Thibaut Cuillère, who is heading our research, analyst research, sectorial analysis, and Eric Benoit, who is our tech specialist. Obviously, if we want to talk about equity valuation, valuation, we need to talk about tech. So maybe to start, to be a little bit on a top-down approach, to start with the asset allocation, Florent. Well, we are in a bit more risk-off allocation, I guess, with the French election, but as well, we were thinking more about the US election coming in. What is your asset allocation for the rest of the year in this context?
Jean-François, we keep the view that we've been having for the last few weeks, which is basically to have a barbell position between cash, short duration, and because we think it's a bit too early and too volatile to get really long duration right now. And on the other hand, to have long equity exposures. So now, it doesn't mean that we'll expect so much returns for the second half of the year. We expect more volatility because there are several issues, in my view. First, fundamentals on the equity market are a bit toppish. Second, positioning is a bit heavy right now. Third, you have also some EPS expectations that are toppish. And of course, fourth, you have some more risk, especially in Europe right now. So European election and French election are bringing some noise. So all told, we are keeping a long position, but we expect more volatility. So we're a bit shifting toward more defensive sectors, more defensive styles. We like big names, big quality names in the US. But again, we think it's also time to benefit from and to use the level of volatility to put some edges and to put some long-short strategies in the equity space to navigate the volatility.
It's hard to diversify in this environment because we see that when you are buying the MSCI World today, you are buying, I think, like 64% of US equity market. So this is not diversification. So maybe a question for you, how you try to diversify, or you get a diversification of your portfolio in this context of huge concentration?
Well, again, a bit long-short strategies, a bit of alternative strategies like CTAs, although they are pretty risk-on strategies right now. A bit some dollar exposure, which is good, I think, and try to get some carry from short duration fixed income.
Thank you, Florent. So a lot of the equity valuation depends on what we think about the tech valuation. So Eric Benoit is our tech specialist. What do you think of this tech valuation that we see at the moment?
Well, first of all, I think we have a big concentration problem right now. In index with 7 stocks, the Magnificent Seven, actually representing more than 42 or 43% of the Nasdaq. Investor positioning remains very strong. Valuations are definitely entering dangerous territory. I think we could mention PE 12 months forward on the Nasdaq of around 27, and then stocks like Nvidia trading around 18, 19 times forward sales on the 2-year horizon. And all of this in a macroeconomic context, higher for longer, which is not particularly supportive of exuberant multiples expansion. So it's fairly normal that people are starting to ask right now whether the situation can last forever. We think actually it can last a little longer. We think investors are extremely bullish on the AI thematic. I think they still expect very important productivity gains, very big profits. So they will keep buying the same stocks. It's not like they have a lot of choice anyway if they want exposure to AI. They will keep pushing concentration higher. They will keep pushing valuations higher. However, in the second part of this year, they will also be a lot more focused on the monetization strategies. Companies like Microsoft, for instance, are spending $12 billion per quarter on their AI infrastructure. They will have to prove that they can monetize the service very rapidly. And that means they will have a big incentive to sell their Copilot suite, which is priced right now at $30 per employee per month. Think about it, for a group like BPC, this potentially means a $35 million investments per year, which is not something you do in a heartbeat. So if adoption takes a bit more time, then investors are likely to revise their assumptions a bit downwards, which in a very concentrated market could be painful for a lot of people.
So cautious on tech valuation. Thibaut, lots of questions regarding credit these days because credit has been behaving quite nicely so far. What can we expect for the rest of the year on credit, in your view?
Well, as you mentioned, Jean-François, credit has been developing quite well, and particularly the high beta part of the market with a total return which is close to 5%, for instance, for additional tier 1. That was until the European elections, which obviously hurted the market, particularly on French names. So basically what we have seen since the last week is around 10 basis points of widening for the senior preferred debt market, for instance, and 15 basis points for the French names, around 45 basis points of rapid widening for the additional tier 1, and even 75 basis points of widening for the French names inside those indices. And definitely we think the risk reward at the moment is not compelling for the credit market. If you take the iTraxx main, for instance, you need to get a couple of figures there, such as the sensitivity of the iTraxx main to the 10-year OAT bond spread is around 0.35, which is quite significant, and which definitely means that we will have an impact from the surge in the political risk in France for at least a couple of weeks. And we think the risk reward globally is probably more in favor of investing in corporate non-financial senior first, where we see some potential for tightening in the best scenario of between 10 and 15 basis points. And the risk in case we are in a stress political scenario is not too high. And then real estate is one of the choice we would do for the second half, given the fact that we have bottomed out in terms of values in most of the segments, at least in Europe. Autos and aerospace defense are also some sectors where we see some value. And for the rest, we are underweight in financials after the great performance that financials have been doing in the first half, and the high betas, and particularly the high betas such as additional tier 1s and corporate hybrids.
We've seen the financial, at least in Europe and in France in particular, with this idiosyncratic risk you were mentioning, a little bit underperforming. You were saying that it's maybe a bottoming out situation for the financials?
Well, for the financials, definitely the risk is that, as we mentioned, they have a great sensitivity to the 10-year OAT bond spread. So that will depend on what is going to happen at the next elections, the legislative elections in France. But at least for the next couple of weeks, we think that financials will be under pressure, definitely, with 2 times more sensitivity than corporates in general for the cash market. Then later on, there will be maybe some opportunities to reinforce there. If it is the case, we think that in that case, the best is probably to focus on either the covered bond market or the senior preferred debt market, where the risk reward is more compelling.
So to conclude, what is your favorite credit strategy for the rest of the year? Just what would you recommend?
Overweight the corporate IG market, definitely, where the risk reward is good. Overweight real estate, autos and aerospace defense, where the fundamentals are pretty good, and there is still some premium compared to the average rating and the relative value across the corporate universe, and underweight the high betas and the financials.
Thank you, Thibault. Thank you, gentlemen. So you see, we are a little bit more on the cautious side compared to what we mentioned last time we presented our forecast. But still, again, even on the equity market, like Florent was saying, as long as we don't see a recession and the monetary conditions are going to improve, this is a global scenario, probably it means that the equity market could be still holding up quite well. So thank you, gentlemen. We move to the last questions. Last question is regarding commodities. Again, it was the name of the game the last 2 years, especially the gas market, triggering this energy crisis, or at least a symbol of the energy crisis. But as well, this is, I think, an asset class. We are discussing asset allocation just before. Commodities is an asset class of choice in our survey. And lots of clients are showing willingness who are quite bullish on commodities. So I'm welcoming with me my 2 experts, very good experts. I'm very, very glad to welcome Joël Hancock, our analyst on oil and gas, geologist, one of the best forecasters according to Bloomberg on oil and gas. And same story for Bernard Dada. He has a lot of gold in its cellar because he wants so many prices on its forecast on gold. So maybe to start with you, Joel, on gas, we see that gas is behaving in a way. We see that the consumption of gas is free falling because of thanks to global warming, probably because of. What do you make of these gas prices and what are your forecasts for the end of this year?
Yeah, so the key, I think, fundamental narrative for the global gas market at the moment is the weakness in European demand, which has been maintained and, if anything, is the result of the very high prices and demand destruction that we saw during the pandemic, during the energy crisis, I should say. So the industrial gas demand loss and also the renewable build-out as well. However, we have seen some higher prices within a lower bound over the past month or two, and that's related to some residual supply anxiety. So there's the threat of losing Russian gas flow via Ukraine, about 42 MCM per day. That transit agreement expires at the end of 24. There's some risk we might lose that early. We have also seen some stronger LNG demand from Asian buyers, but we think the critical point is that although that does support a higher price level, it's far more muted than what we're seeing in 2022. So we're maybe expecting to see winter prices now around about 44 euros per megawatt hour. Our previous forecast was more about 36, 37. So that level would price off some residual demand. So you'd see some switching between coal and natural gas, maybe some industrial switching as well. But the market can handle that a lot more comfortably than it did, say, 2 years ago.
Thank you, Joel. And what are the level of stocks of gas in Europe these days? Are we very comfortable for next winter, given the stocks we have today?
Yeah, exactly. We're about 72% at the moment, and that's in line with last year, which was a record high for that time of year. So this is one of the main reasons we're not seeing this spike scenario, despite the emergent supply loss.
Question on oil. What about oil in this scenario? You say there are lots of geopolitical risk, obviously, everywhere. A war is still raging with the invasion of Ukraine by Russia, with the Middle East situation as well. What is your scenario for oil for the rest of this year?
Yeah, for the oil market, it's interesting because it's not incorporating the risk of supply loss as much as the European gas market. And that's mainly due to OPEC. So they've handled 3 cuts since 2022. At the moment, they're holding about 5 million barrels per day of spare capacity. The latest OPEC agreement extended those cuts through the third quarter. When we look at our fundamental balance, it does look relatively tight for that quarter. So we are expecting to see pricing around about 87, maybe even up to $90 per barrel for the third quarter. 2025, the balance shifts a lot more loose. So demand growth is slowing down. We are seeing higher non-OPEC supplies. So OPEC will probably have to start to bring, halt some of their return of these barrels that they agreed in June. And in our view, there is a risk that OPEC, the broader agreement does break down. We lose some of that togetherness within the group, and that could result in lower prices for 25.
Thank you, Joel. And we see all this question regarding, again, the peak of oil demand with China moving super fast on its electrification of its energy. I was in Saudi Arabia of late, and I was very surprised, or not surprised, but we have seen that Aramco are saying that probably the bulk of their reserves are going to remain below Earth, and they are looking at alternative to oil. And at the other end of the spectrum, with the Trump election, we discussed that earlier on, but Trump, one of his key words of Trump is drill, baby, drill. So probably the production of non-OPEC countries. I think US is now 45% of the OPEC production of oil. So you see this rebalancing going forward probably. If we move to the, talking of Trump, we have seen a tremendous performance of gold in this risk-off scenario that we have seen of late. Is it going to last, this story on oil first, and then maybe we talk about metals?
Yeah, so for gold, I think it's a very interesting year because we've seen that the price discovery mechanism of gold has moved from the West to China. So China has been the price setter of gold So in the West, what we saw this...
Not India anymore.
Sorry?
Not
India.
Anymore.
The largest consumer, the largest importer, the largest producer of gold is China since 2010. So China has been actively trying to move or to create itself as becoming a global hub for gold. And this year, we've seen the price discovery mechanism move to China. So real rates in the West have been very high. So when real rates are very high, the opportunity cost of holding gold is high. So we've seen investors selling gold in the West, but Chinese demand has been able to more than offset Western sales. And so what we've seen is prices reaching a record high. And we think that for next year, Chinese demand remains strong, plus rate cuts in the US. That should be a very positive story for gold.
Thank you, Bernard. Question on critical metal, not the critical metals, but clearly what we have seen of all these metals linked to the energy transition. Again, the whole world is accelerating like mad. It's the transition to electricity. And the symbol of that maybe, well, we can think of lithium, obviously, but symbol of that is maybe copper, because we have seen going up like crazy, then down, and then up again. What do you think of copper? Is it the metal to watch?
No, copper is one of the pillars of the energy transition, especially for the transmission of electricity, among many other things. And the issue we're facing with copper currently is the severe underinvestment over the past few years. So capex had been dropping. So long-term capex had been dropping. We've seen them pay record dividends as opposed to investing in long-term. The shareholders are not really thinking long-term; they're thinking dividends now. So with just to let you know, with the copper project, you need, if you start a mine from zero, you need 17 years. 17 years from, on average, from the day you discover to the day you start producing. If you want to expand,
and are we sure, sorry, Bernard, that we are going to need? Yeah, okay. Are we sure that we are going to need copper in 17 years from now?
Yeah, well, from 17 years from now, probably. You know, the energy transmission, I'll tell you within the next 10 years, probably 17 years is harder for me. But yes, copper is a pillar of the energy transition. We currently, aluminium can be a substitute for copper, but not in everything. So I would say we're very bullish on copper on the back of underinvestment, as opposed to lithium, where we're seeing a lot of projects coming online and we're seeing maybe some oversupply in the market.
Just to finish, one sentence from each of you guys. What is your forecast for gold and copper end of this year? And same question after for you for oil and gas.
So gold, we're reaching 1,400 and 1,500 as an average for 2025. Copper, 10,000 as an average into next year.
Oil and gas?
End of the year, we see Brent around $82 per barrel, so easing from our Q3 forecast, which is relatively elevated. Winter average for TTF around 44 euros per megawatt hour. 44.
Thank you, gentlemen. Thank you very much. So commodity, again, probably remains one of the key elements to look at, big for inflation, GDP growth, but as well for this transition, green transition. And we are following that, obviously, very, very closely with our experts. Thank you, gentlemen. I think it's fair to say this close up or mid-year outlook session. Overall, like I said, I think it's the global picture that we have within Natixis Research CIB is one of not Goldilocks once again. GDP growth is going to behave. Disinflation, we are still buyer of this story of disinflation continuing in US, in Europe especially. So central banks are going to start or continue their cutting cycle. Well, having said that, we knew that the geopolitical risk will be one of the main risks. Well, this is it. We have seen that with the French election outcome, and we are going maybe to see that with the US election. So lots of things to follow, lot more to be said. Well, you can find our publication probably before the end of this week, taking a bit of a more broader view on these topics we addressed today with you. Do not hesitate to reach out to our experts. We are more than happy to discuss, to visit, and to exchange. And as usual, you can see our publication on our research.natixis.com and our social media as usual. Thank you very much to be so numerous joining us today. This is a great challenge to continue on this path, and we will try to do that next December for 2025 Outlook. Thank you very much for joining us.